My partners and I looked at this really carefully. I would say, number one, the large U.S. banks are better capitalized and have less risk than they ever had in anyone's lifetime. The European banks, while they're not as well capitalized, are certainly better capitalized than they are. That isn't to say there won't be pain if Credit Suisse goes down, but it's not an '08, thankfully. People have been pulling back from Credit Suisse from a long time. If you hear that the company goes bankrupt, there will be losses. It's not death-defying losses, but it'll be a problem. It's not going to take down the system.
In terms of what we've seen in the reaction across the European bank sector, it's true. I guess it's, everybody wants to get out and then figure out
Well, it's a little bit of what I'd call PTSD from 2008. Sell and ask questions later, which is not a bad strategy because the news is probably just going to get worse. The news that Switzerland is trying to bail out the company. To give you a perspective, in 2008, when everybody was trying to get bailed out, if you looked at the U.S., the size of U.S. GDP was many multiples bigger than all the bank balance sheets combined. We looked at Credit Suisse today. Credit Suisse balance sheet is $500 billion. The GDP of Switzerland is $800 billion. So could Switzerland do something? Yeah, they could do something. It's not going to be easy. The other thing I would say about Switzerland, unfortunately, is they really don't have a lot of regulators. So what they actually know is not, I don't think they know a lot.
That's frightening.
Like if you look at Germany, there's what I've heard is like 500 regulators in Deutsche Bank every day.
Right.
I think the number of regulators of the Swiss bank, I could be wrong, is like 250 for the whole sector.
But that statement paired with the notion that Credit Suisse might be too big to save is sort of a frightening.
Well, it's frightening and it's not franking. It's going to be ugly.
Right.
Credit Suisse, I'll say euphemistically, has been a problem child in the investment banking industry for as long as I can remember. And it's always had cultural issues. But, it'll get unwound. It'll be painful. It's only going to be painful for Switzerland. We heard today that they maybe want UBS to take it over. Believe me, UBS does not want to take it over. That's for sure. So I don't know how they're going to unwind it. They probably will have to. Is it possible that they could save them? Maybe. I heard that they were offering 6 to 7% deposit rates in Asia, and people were still pulling their money, and nobody will be a counterparty anymore. That's more than bad. That's really bad. So how Switzerland will deal this, it's anybody's guess. I'm not in the room.
Yeah.
So let's switch to the U.S. for a minute. So with what's happened over the last week that's been revealed, and who knows what hasn't been revealed yet, do you see that we're in a new era now for regional banks, for what the model will be and how to think about the whole banking structure, the whole sort of business of banking?
It's not a 5-minute question. Let me start with, when President Trump passed that bill and raised the threshold from, I think it was 50 to 250, now, I think that was bad. I think Elizabeth Warren has a real valid point about it. But we looked at the stress test for last year. So even if Silicon Valley had been in the stress test, given what the stress test says, I don't think the regulators would have caught it.
They would have passed it.
And, the stress test is basically fighting the last battle. That battle has been won in the large banks. They're better capitalized. Their risk, even with that capital, is much narrower. As Warren Buffett says, when the tide goes out, you see who's naked. This is a different tide. This is not a credit tide. Credit quality in the United States is really good. This is a tide of a mistake. That's why Silicon Valley failed. Also, they failed because they had a very, very concentrated type of deposit base, which has a very big herd mentality.
In trying to figure out whether or not you invest in regional banks, you're trying to figure out, well, what can they regulate to prevent this? This is a very specific situation of interest rate risk, which may not come up again for a long time.
Well, we have it now.
We have it now.
And let's say the government doesn't bail anybody out. So clearly JP Morgan and Bank of America benefit. And it turned out, even though they did get bailed out, JP Morgan and Bank of America benefited. So our first thought was, well, maybe we should buy JP Morgan and Bank of America. And then upon further reflection, we were like, maybe not. Because given what's just happened, all the regulations are probably going to get much more stringent, making the banks much less profitable. And that's not going to be clear for many, many months. So why be a hero? Because you have absolutely no idea what's going to happen.
Would you say that the banking sector right now, with the uncertainty given what will happen on a regulation front, that financials are uninvestable right now?
The best you can say is you don't know. And if you don't know, you shouldn't play.
Wow. So then what do you do? Let's say you clear out your position because you're like, you know, we don't know. We don't want to play in this pool. What pool do you go to?
Well, that's not an easy question.
Well, yeah, but
I think what's happening is we're moving from one paradigm to another paradigm. Mm-hmm. So the paradigm of the last several years has been rates are very low, you're paid to take risk, and you're actually paid to take a lot of risk. So, you know, what did the best over the last 10 years? High growth tech stocks. And what did the best within high growth tech stocks? Super high growth revenue stocks with negative earnings. Okay, so what did the worst last year? Super high growth stocks with negative earnings. Now, are people going to go back to that? I don't think so, especially if rates stay up. Mm-hmm. So what I think is coming is Tina is dead. Number one, I think you're going to have a much more diversified portfolio. You certainly can leave money in your money market fund because it's over 4%. I'm not sure if it's over 4% tomorrow,
maybe not
but
anymore.
It's still around 4, which is fine. I think over time, you'll be able to buy some treasuries and buy some bonds. And there are going to be a lot more themes than just tech, infrastructure, bringing in the supply chain back to the United States. And you're going to need to manage risk a lot more than people have. So, you know, people who's outperformed over the last 10 years? Tech investors. You know, the group is now so volatile, I think everybody should take their exposures down. Not that you should invest in tech at all, but you really should diversify more of your portfolio, take down your risk, manage your risk, tailor your portfolios to your clients. One size does not fit all. And given the fact that, you know, my team and my partners and I, we go back every single day. Is there a recession? Is there not a recession? I watch your show. You've had people come on and say there is a recession, and a month later they said it's not a recession. It's a very uncertain time because we've never had the confluence of stuff that we have today. And I think that argues for taking less risk.
Right.
But Steve,
go ahead.
So if we haven't had recession yet, and the S&P never bottoms before a recession, in terms of market sequencing and the fact that we've seen these credit reverberations and bubbles just start, I mean, how do you see this playing out, both in terms of, you know, you don't need to give us the crystal ball on levels on the S&P.
I mean, let's talk about next week, for example. You know, at the beginning of the year, good news was good, bad news was bad. And then in February, good news was bad, bad news was good. And now let's talk about next week. So, I mean, 50 basis points is off the table. So either they're going to do 25 basis points or they're going to do nothing. So let's start with the nothing. You know, I got calls for today that, well, because of Credit Suisse, maybe the Fed will do nothing, and that's really positive. And my response was, really? You're rooting for a financial crisis so that the Fed won't raise rates? I mean, if the Fed doesn't raise rates, I mean, maybe it'll be positive for a couple hours or a couple of weeks, but the Fed won't be raising rates because it's scared. Well, if the Fed is scared, you should be scared. Mm-hmm. You know, on the other hand, if the Fed raises rates even in the face of this by 25 basis points and says that we still could raise more, then that's like, wait a minute, you're sort of caught between a rock and a hard place. Financial conditions have really tightened, but you still have inflation. It's not clear either move is good.